Hi, I'm Pattu from freefincal. In this video, let's talk about what is the impact of adding a small amount of gold to a long-term investment portfolio, say 10% or 20%. This is a question that many readers, viewers have asked me from time to time. Now, before we get on with it, I want to first thank you for your show of support and encouragement to my last video. I did not quite expect that. I guess I have not spoken about my autoimmune condition for a long time. So that kind of surprised a lot of people. They were hearing it for the first time. So in any case, I thank you for all your support. I am overwhelmed by all that. So now coming back to gold, the point is that there's really no harm in adding that much, but will it make a big difference to your portfolio? We will see that the answer is sometimes it might, sometimes it may not. There's really no way to say this before. And the more asset classes you add, the more difficult it is to rebalance the portfolio and maintain it. So let's see how that goes. Now, the most important aspect of gold price in India is that these are the 15-16 year rolling returns of gold INR, which is the brown line, and gold USD in the yellow. You can see that in the 90s and in the early 2000s, there was a huge difference between the returns because the INR was very weak and the INR was giving you the big push. It gave you the huge return push. You can see that gold USD in the 90s were like, minus 1% or minus like 2% or 3%. Whereas because of the INR, the gold in INR was about 8% or so. So of course, at that time, you can argue that fixed deposit was like 12% or so, 10% to 12%. So at this fixed income was doing much better and less volatile than that. But after that, you can see that these two graphs are now started to align, and you can see they're going in step. And you can see for the last 15 years or so, 16 years or so, they've been in step. And that's because the currency has become a lot more stable. And many people are betting against our own currency. I find this really, it's a very poor strategy, or at least thought process, because I think our currency has become very stable. I think in spite of all the problems, or despite all our problems, our economy is growing and our currency is becoming stronger and stronger day by day. So you won't get the returns that you have seen in gold or any other asset classes related to currency like in the past. So things are going to change, and we will see that again in this backtest. So what we're going to do is to run a backtest for two portfolios. One is 60% equity and 40% gilt. The other is 60% equity, either 10% gold or 20% gold, and the rest is in gilt. So we shall look at data from September 1996 to August 2022. So that's 132 15-year windows. Only 132 15-year windows, I must add, because if you look at 15-year windows for S&P 500, it will be like thousands, right? So we have very, very short market history. We have to make do with what we have. So these are the XIRRs for those 132 runs. The black is the equity plus gilts plus gold. The red is just the equity plus gilts. And you can see that there are many times where adding the gilt has outperformed just the equity plus gilt portfolio. However, for the last 17 years, that has not been the case. The two returns have more or less been the same. And that is because of the currency stabilization, which I just talked about. And 75 out of 132 runs, the adding gold has added a return difference of more than 1%. That is, the return is higher by more than 1% for 75 out of 132 runs. So that's like 56%. So it doesn't happen all the time, and it does not happen for the last 17 years. That is the most significant information that you should take away from this video. So you can see the return difference. You can see that not all the time that the return difference is high. There are significant data points here, like those 75 data points where the return difference is more than 1%, because more than 1% can be thought of as significant, but even that, because of taxes and so on, will come down, because gold is also taxed like like a debt fund. Please don't say I'll buy sovereign gold bond. You can't use sovereign gold bonds for portfolio management. It's just silly. You can't do that. And so this is with 20% gold, and you can see here the green line is the beta. We'll come to that. But below that there are two lines. There's a blue line and a brown line. That's the volatility of the blue line is the volatility of the with gold portfolio, and the brown line is without gold. And you can see that the volatility is basically the same, whether you add 10% or 20%. This is with 20% gold. It's really not too much of difference in the volatility of the portfolio. This is the beta of the portfolio. That is how much the risk has come down relative to that of the without gold portfolio. That is, by adding gold in a portfolio, how much has the risk come down? You can see not by much. You can see it just hovers around 98, 97, 98, 99%, a little bit high. Sometimes it's a little bit higher than 100% and so on. So it's not really much of a difference in the beta as well. Yes, the adding gold has typically outperformed with respect to the backtest. However, the margin of outperformance is significant, only for about 56-57% of the runs. There's not much of a difference in the volatility, and also the difference in the beta. There's not much, but of course there are two. Beta is the relative volatility, so you can see that in the beta also. And most importantly, this outperformance has not been there. Adding gold has not outperformed a standard equity plus gilt kind of portfolio for the last 17 years. Again, this is most likely because of the stability of the INR. So my take on adding gold is there's really no need for it. It's just going to make your life more difficult. You have to account for taxes more. You have to account for the rebalancing becomes a little more cumbersome, and most of us will never be able to find out the whether gold has gotten any impact or not. The truth is, most people ask this question when they see gold has moved up for the last 5 months or 6 months. Then they ask, can I add gold? Similarly, when they see S&P 500 move up, they will say, can I add S&P 500? That's just, it's childish behavior. So let's not. It's simple. Equity plus gilt portfolio is enough in most cases.